Recently, in 2017, it was my biggest year yet in angel investing, and I invested in 3 deals. One of them I actually made 2 investments in the same company. And I wanted to discuss my experience today, particularly with these safe agreements and convertible notes. Hey everyone, this is E and I am back with another video about investing. So for those of you who have been following me for a while, you know that I mainly invest for dividends and cash flow. I invest in dividend-paying stocks, real estate, and other instruments that pay increasing streams of cash flow over time that can directly pay my bills and fund my living expenses. Well, one thing I wanted to share is I also happen to be an angel investor. And so I also invest in technology startups, privately traded companies that are not public yet. And I do this with a smaller percentage of my portfolio. I do it with around 10% or less, never more than 10% of my portfolio. And the reason that I do this is, one, I enjoy investing in friends, people that I know, people that I believe in, and so it's really, really fun to invest in dreams, those dreams of my friends, especially when I know they're going places and they're going to do really well, or they've already been a serial entrepreneur, they've already done really well in the past. But also it's a way to supercharge my returns. And so I like to look at this 10% of my portfolio as a means of generating superior returns. And sure, it carries some more risk, but so far I have never lost money on an angel investment. Some of my money has been tied up for a while, and I have investments that have done well, but I'm not able to cash out of them yet, and we'll get to that later. There's a very long time horizon on angel investments, but I have never lost money yet. And so I've been very careful, very picky, very choosy with my angel investments, and it's been a way of garnering these superior results in my overall financial portfolio. And the benefit of that is when I can eventually cash out of an angel investment, and it can take some time. I'm usually in these investments for, I would say, a minimum of 1 decade. Once I can cash out, I can take that capital and invest it in traditional cash flow instruments, such as dividend-paying stocks. So the purpose of today's video is actually a little bit of a technical one. Recently, in 2017, it was my biggest year yet in angel investing, and I invested in 3 deals. One of them I actually made 2 investments in the same company. And I wanted to discuss my experience today, particularly with these safe agreements and convertible notes. And so when I was investing in these, I looked on the internet and I could not find a ton of information. And so I thought having a video about my personal experience with safe agreements and convertible notes would be really helpful. And also, even if one is not an angel investor, I think these insights are helpful in that they show some of the more technical sides of investing, more of the technical sides of reading all of the paperwork. And that's something that I think a lot of investors forget. And I think it's a very important part of investing is reading through all of the documentation and understanding every aspect of an investment. And so, as I always do, I've got my notebook. Let me just open up here. I jotted down a bunch of notes. Before we jump into anything, let's just go through definitions. Safe agreement, what is that? It stands for simple agreement for future equity. So, when a startup is very small, very, very small, I'm talking market capitalization, theoretical market capitalization of a few $1 million or less, they typically have raised money only from the founders, the founding team, and potentially some friends and family investors. I fall into the friends and family bucket. I have a great network. I've spent a lot of time building it, a lot of friendships, and a lot of friends who have been serial entrepreneurs and successful serial entrepreneurs who have built great companies. And so typically when a company is really small, they have not gone out and sought venture capital funding yet. They've typically funded through their own pockets and through friends and family. And typically there are some advantages for companies waiting longer and pushing out those big VC rounds because a VC round typically can dilute the ownership percentages of the early stakeholders. And so the more that one can push it out, oftentimes it's advantageous to push a VC round out just a little bit further. Now, the challenge with raising money for these smaller companies is it's actually quite expensive to peg an official market capitalization, an official valuation on a company. Upon speaking to some of my friends, my understanding is that it can cost as much as $50,000 to hire a legal firm who will do the process, get everything done properly, and officially determine the valuation of a company. And so what a lot of companies have done, these smaller companies who are not ready yet, they're not ready yet to hire the legal team to do the valuation, they're not ready yet to have a bigger round, an A round of venture capital. Typically what they do is they will entertain a SAFE agreement, a simple agreement for future equity. And what this simply means is it's an agreement where an investor like myself can invest in a tech startup or any type of startup before there's a market cap valuation, and it says, hey Ian, at the time that we do raise money from venture capital or institutional money, and it's of a certain amount, we will convert your SAFE agreement over into equity. And typically we will do it according to these terms in this agreement. And so a SAFE agreement is a way for friends and family to help out in the early stages. It's a way for friends and family to get involved before the venture capital rounds are raised. And there are some advantages and disadvantages of doing this, and I'm going to go through these today. But before that, obviously just wanted to give the definition. So also I want to talk today about convertible notes. So a convertible note in the world of venture capital, the world of angel investing, from my experience, has been very similar to the SAFE agreement. Typically what a convertible note is as the name implies, note, it's a debt instrument. So the investor, myself, is lending money. Now, the fact of the matter, however, is the interest rate's really low. Typically the interest rate is the minimum required by law, and I'm not going to make a lot of money on the interest. The purpose of this note is really to convert. It's the convertible part of the note that one invests in these convertible notes for. At the time of an event, of a trigger event, again, typically speaking from my experience, it's a institutional round of equity that's being raised. The note will convert over into the equity, and so it can perform very similarly to a SAFE agreement. And in my personal angel portfolio, I have both. And so I want to go through some of the pros and cons today and some of the big points, the big things that investors should be looking out for with each. So first thing that is really important is the timing. If one holds a SAFE agreement or a convertible note, it makes a lot of sense to understand, hey, what's the timing? When is this SAFE agreement or this note going to convert into equity? Is it going to be a few months from now? Is it going to be a year, 2 years? What is it going to be? And so typically I like to speak with the team. I only invest in tech angel startups that I really know the co-founders. Oftentimes I've done consulting work for them, or I've partnered with them. I've done partnership work with them. And so I know the teams. I'm on a first name basis. I will simply ask them, what is your plan? And typically I will only like these agreements, these opportunities, if it's going to convert over within the year. I'll give it 12 months, but if it's more than 12 months and it's going to convert a long time from now, typically that's a little bit longer than I would like for the conversion into equity. Now obviously once it converts into equity, then I typically imagine I'll be in these investments for at least a decade before I get my principal and my returns back. And so it's a very long-term proposition, but just from an equity conversion standpoint, I like to look at around 12 months. Now, it's always important to have a contingency, a buffer, and so typically if the co-founder says, hey, it's going to be the next 1 or 2 quarters, I'll kind of peg that more at, well, maybe it's 3 quarters to 4 quarters. And so there's always going to be a delay, and so that's something I've found that's been really important with my planning decisions around these agreements. So typically also regarding the timing, When will it convert? Well, from my experience, it's typically defined in the contract, and it's defined as when an institutional round of capital is raised. And typically a big institutional round, typically be in like a $6 million range or up. And so if one of these early stage companies goes out, raises $6 million from Sand Hill Road, well, that will be a trigger event. My SAFE agreement will at that point convert over into actual shares of equity. And so it's important, however, to look at this note and look at these SAFE agreements. If the threshold is like a $20 million round, that may be too big of a round because it may take too long to do that round. But if it's maybe a $6 million round, that's a lot more reasonable for a smaller company to raise $6 million than $20 million. And so understanding the timing is of key importance on investing in a SAFE agreement or convertible note. So next point, discount percentage. This is probably one of the most fundamental concepts with a SAFE agreement or convertible note is, why would I not just invest alongside the venture capitalists? Why don't I just wait for that $6 million round and invest in parallel with the VCs? Well, a few things. One, maybe I won't have that opportunity. As an investor, what I've found is when there's an opportunity and I like it, typically I should take it. I like to seize the moment because those moments don't always persist. It may not be, that opportunity may not be in the future. Maybe when they do the institutional round, they won't allow friends and family in parallel. Maybe they will, who knows? But I like to lock something in early when I really like it and when I know it's something I want to align myself with. But more than that, these early investors like myself are typically given a discount percentage. And what this means is when, hey, the equity financing happens institutionally and the SAFE agreements convert over into equity, typically there's going to be a discount ratio for the SAFE agreements for the time that they've been in the investment. And so what I am typically comfortable with is a discount percentage anywhere between maybe 10 and 25%. And so if, for example, the per share price at time of conversion for the VC is $1 and I have a 25% discount, my price per share will be 75 cents. That's the magic of getting in early and having a SAFE agreement with a discount percentage. Now, having a 10 to 25% discount, I think that's a reasonable rate of return for a 1-year holding period of the SAFE agreement or convertible note. And I think it's a reasonable amount of return given the risk I'm taking on. And maybe even over a 2-year period, somewhat reasonable. But the more time that goes by, 10, 25% becomes a lot less of a discount given the amount of time money is tied up. And that's why it's important to understand the timing and also the discount percentage. Something else that's really, really important is what's called the valuation cap. And now, before I even get into this, one thing I would caution everyone out there is just read these agreements, because every agreement's different. Every one I've ever read, they're all different. And so some of the concepts I'm discussing today, they may make it into your agreement, they may not. And so it's important to understand if these concepts are in there or not. Now, what a valuation cap means is, actually, I've seen it used a few different ways. Let's talk about the first way. It's protection insurance against runaway valuations. So let's say I invest in a SAFE agreement now. And let's just say the company's just getting started. The aggregate value, it hasn't been determined, but hypothetically it's probably in $1 to $3 million range. It's not worth a lot. Let's just say it's a runaway success. A year from now, the company raises VC money. The valuation is pegged at $100 million. And for holding it that year, let's say I get a 25% discount. 25% discount on a $100 million valuation, when I got in, when the thing was just getting started, that's not very much a good return. It's not fair. It's not commensurate, or it doesn't allow me to participate in the upside that happened. And so what a lot of SAFE agreements, sometimes convertible notes, will do is they'll have a valuation cap. And what it means is, hey, when your note or your SAFE agreement converts over, we're going to use what's more advantageous for you, the investor. We're going to either take the discount percentage, or if you had a runaway valuation, we won't use the discount percentage, we'll use the lesser of these two, and if the lesser is the valuation cap, we'll use the valuation cap. So here's an example. Let's say valuation cap is $20 million. This company that's raising money at a $100 million valuation, if the valuation cap is $20 million, my safe agreement will convert over at the $20 million valuation. So I'll get a hefty discount, much bigger than the 25% discount percentage. And this is how a valuation cap can protect the investor from these runaway scenarios. The other way I've seen valuation caps used is, what if there's a time deadline on the safe agreement or the convertible note? At a certain deadline, the agreement has to convert. It's not just going to perpetuate in perpetuity. It's not just going to go on. It has to convert. And let's say at that set time, I've seen in my experience this often can be a few years, like let's say 2 years out. Nothing's happened. No VC funds have been raised. There's been no huge institutional event. Sometimes what happens is the valuation cap is used just to say, hey, well, your shares are going to convert over at said valuation cap. So if the valuation cap was $10 million, it'll say, hey, Ian, after a few years, if we haven't raised institutional financing, what we'll do is we'll take your investment, we'll convert it over into an equity stake, we'll do it at the valuation cap valuation. Now, what's really important here is to be very, very comfortable with the valuation cap. And so when I am analyzing these opportunities, I'm looking at the due diligence, I'm looking at all the numbers. By the way, I will not invest in a tech startup unless I've seen the numbers. Sometimes I've had these opportunities come to me, they're really good, but if I can't see the income statement, the balance sheet, all of it, the cash flows, it's hard for me to evaluate. I'm a numbers-driven investor. I don't invest just in a dream. I don't invest in tech startups that just have the hope of growing users or eyeballs. I invest in companies that are growing revenues, they're growing earnings, and the best angel investments, in my opinion, are just those. They have a solid track record of growth in terms of revenue and earnings. And sometimes the earnings will be break even, that's fine. Early stage company, all of the money's being reinvested, things are tight, things are scrappy, but at least I don't want companies that are losing money, and I don't want companies that have anything but rapidly growing revenue. And so anyways, I look at all the numbers. If I don't have the numbers, I won't entertain the investment. And when I look at the numbers, I try to understand, hey, if there's no institutional round, when it converts over, am I okay with that valuation cap? And if I'm not, that would be a deal breaker in the investment opportunity. So what else are some of the big things I look at with these types of investments? Very important. Sometimes there's this clause in these agreements, and this is why one has to read very carefully. And the clause will be essentially a buyout clause. It will say, hey, at some point in the future, we could choose to buy your note back. And I've seen this pop up before. Basically, it'll say, we'll just buy it back from you. We'll give you back your principal, your interest. We'll buy it back. And that's not really cool, in my opinion, because let's say it's, one day before the conversion event's supposed to happen. Let's say the company is doing really well. Theoretically, they could just buy back my investment, and I would see none of the upside. And I wouldn't participate for the amount of risk that I'm taking. And I don't think that this would happen because I only invest in people that I trust, people that I know. That being said, who knows? Maybe there's a change of control. Maybe the company gets sold to someone else. Maybe someone else is in charge. You never know. And I like to protect myself as an investor. So if there's a buyout clause, I will ask to get it struck from the terms. And if they can't strike it, that would be a deal breaker for me. Another thing. There is this concept called an accredited investor. And what an accredited investor means is typically one's net worth or one's income is at a level that allows them to invest in these types of investments, these high-risk investments. When one invests in an angel investment, there's two types actually under the code. One are angel investments where the investment is not solicited. It's literally me being scrappy, going to a friend and saying, hey, I want to invest in your company, can I do it? The other kind is when the company is actively trying to raise funds from angels and they're reaching out via sales and marketing. Both of them require one to verify and attest that they're an accredited investor. The second one, however, actually you have to go through more extensive means to prove it, usually through a third-party verification service. Now, what's really important is if one is considering these investments before doing anything else is just to make sure, hey, am I accredited? Do I pass the bar? If one does not, one should look at other types of investments. They're just not going to be able to participate. And that's okay because these rules are in place to protect investors. And in my earlier career, I wasn't at the level where I am now. I couldn't invest in these types of things, and so I had to be scrappy. And one way that I was scrappy is I would work for tech startups. I would get employee stock options. That was a great scrappy way to get equity in technology companies without directly investing as an angel. I had to work at the company to get employee stock options. Another way that I invested in these companies is through just building them myself, starting companies. And so I've started a few companies in my day, and that was another great way just to get exposure to the tech startup scene, to see firsthand what it's like to run a company and learn skills while making some money. And so there are other ways to invest, but being a direct angel investor requires one to be an accredited investor. And so that's an overall screen. It's going to be really important that everyone passes before they entertain these types of opportunities. And in the short run, if one is not accredited, maybe it's not time to do these investments, obviously, because one doesn't pass the test, but one can start thinking, one can start evaluating, one can start building their network, and so when the time does come, that network is in place. And this is how it worked for me, actually. I had such a great network that by the time it was right, I was able to move forward with the angel investing route. So, before I close out today, just a point. These angel investments carry very high risk. When I go into them, I have the expectation that I will never see my money back, and they are a very small percentage of my portfolio, and I only do it because my portfolio has reached a size where it makes sense. I want to supercharge my returns. And I have the expertise. I have a computer science background. I have from Stanford University. I have the expertise. So this may not be for everyone, and that is okay. But I wanted to share this video today more from an educational standpoint so that folks can start learning all of these intricate things that go into these deals. It's quite interesting, quite fascinating. Half of the fun here is just navigating these agreements and understanding everything. It's like a big puzzle. And also I want to share this today just because I did not find a good source of information on the internet about safe agreements and convertible notes for very early stage startup investments. So I hope my video was helpful today. I know it's a little different than my cash flow and dividend investing videos, but nonetheless, I thought it would be fun to share this topic. I want to thank you for watching. If you enjoyed the video, if you could give me a like, a subscribe, a comment, it would mean the world to me. Before I leave today, just a friendly disclaimer. I am not a licensed financial advisor. Today's video is not financial advice. It is just for your fun and entertainment. If you are going to go out and invest in angel investments, the stock market, anything else, please do consult a licensed financial advisor first. My name is Ian Lopuck. I'm from ppcian.com. I will see you in the next investing video.